Okay, so here is about $25,000. So the question is, if you had a spare $25,000 laying around, how would you invest it in the Australian stock market? Now, of course, there's a couple of trains of thought. One is you either invest the whole lot in a lump sum on one single stock, or you buy one single stock over a period of time by using a method they call dollar cost averaging. So rather than putting the whole lot in at one go, we break it up into lots of 1,000 and maybe invest $1,000 every month over a period of 12 or 24 months, maybe a shorter time, 3 months, whatever. Or, of course, the other option is to diversify your portfolio and spread the single amount, the $25,000, over, say, 25 different stocks, $1,000 per stock, or over 12 stocks, a couple of $1,000s per stock. So either we diversify our portfolio to minimize risk, we dollar cost average, so we buy a stock that we want, but we don't just put all our money into that one stock today, we spread it out over a period of time, or we just dump it all into the one stock, which is referred to as lump sum investing. When it comes to dollar cost averaging versus lump sum investing, it seems everybody's got an opinion. If we search on YouTube, dollar cost averaging versus lump sum investing, we get a horde of different videos and everybody's saying different things. There are plenty of people who say dollar cost averaging is the only way to go. And there's just as many people who are saying that lump sum investing is the only way to go. If you truly believe in the market or the stock that you're about to invest in, why not just put all your money in? If it goes up, you're going to make more money than if you hesitate and take your time to invest over the period of the next 12 months or so. And there's advantages and disadvantages for both, and we're going to have a look at those in this video. Rather than just trying to guess, I'm actually going to backtest some data, look at the facts and the statistics, so we can make a more informed and educated decision about our investing styles. Okay, so in case you're uncertain what dollar cost averaging actually is, let's have a quick look at the Investopedia definition of it. Dollar cost averaging, or DCA, is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. In effect, this strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. Dollar cost averaging is also known as the constant dollar plan. Now, when we're talking about dollar cost averaging in this video, we're not talking about periodic investments that you would probably do in your superannuation account, or simply buying shares every time you get paid. Periodic investment is you're restricted to buying the amount of shares you can because of you haven't got the money to do it in a lump sum at the time. And of course, we're all involved in superannuation accounts, so to a degree, we're all dollar cost averaging into the markets. What we're talking about here today is if you had a lump sum of cash and you had the choice, do you put it all into the market in one hit, or do you spread it out over a period of time? Imagine you were looking at a stock chart and you saw a stock that had been going up for a little while, so you decided to buy some shares. And you entered in at this point here. Now what if the shares went up and then suddenly crashed? To the point where you decided you couldn't take it anymore, so you sold out and took a loss. Let's add some price points to this chart. Let's imagine at this point the stock is $12 and down here it's $6. Let's also put some months along the chart, along the x-axis, and we'll call these February, March, April, May and June. Now, as a lump sum investor, you'd have bought this stock for $12 before selling it for a 50% loss down at $6. Implementing the dollar cost averaging strategy, you would have bought this stock at $12, in March purchased some more shares, April purchased some more shares, May purchased some more shares, and we'll add some prices here. Let's call that $7 in May and $8.50 in March and April. So let's see, how did the lump sum investor go? Let's imagine that the lump sum investor started with $4,000. $4,000 at $12 a share would give our lump sum investor 333 shares. 333 shares, when they've fallen to $6 per share, is $1,999. So in other words, the lump sum investor has lost half of his or her money. Let's now look at the dollar cost average investor. Now in this case, the dollar cost average investor is taking his or her $4,000 and has decided to invest it at $1,000 per month over 4 months. In February, the shares were trading for $12 each, so our dollar cost averager is able to buy 83 of them for his or her $1,000. In March, the shares were trading at $8.50, so $1,000 would give our dollar cost average investor 117 shares. And of course, April, the share price was still at $8.50, so our dollar cost averager accumulates another 117 shares. In May, the share price fell to $7, which meant our dollar cost average investor was able to pick up 142 shares. So in total, our dollar cost average investor is better off than our lump sum investor who only had 333 shares. Our dollar cost average investor ended up with 459 shares. And while still sitting on a loss, the loss is a lot less for the dollar cost average investor who has a portfolio worth $2,754, is actually $755 better off than the lump sum investor. Psychologically, the dollar cost average investor is also probably in a better position because they've been buying shares each month as the share price is falling and the stocks are cheaper, rather than our lump sum investor who bought them in February and has been watching the share price fall ever since. Now, like many Australians, you might have got really excited when Telstra first listed on the ASX, around about 1998. And at that point, the shares were trading for about $8 or $9. So you might have taken your big wad of cash and dropped it all on Telstra shares, thinking, great Australian company, this is going to go really well. So maybe you bought the shares around $8 or $9 here in 1998, only to watch the share price plummet over the coming years, where 12 years later, Telstra was trading for about $2.50. So you would have seen your $25,000 suddenly whittled away down to less than $7. That's gone. So, not a good proposition. Now, dollar cost averaging, on the other hand, would have given you the opportunity to buy Telstra monthly, quarterly, yearly, as the stock price was falling. And you could have even used this as a defensive strategy to keep buying shares of Telstra on the way down, so that eventually, rather than taking a loss, you could break even, or even get out with a small profit. Let's say, for example, you purchased $1,000 worth of Telstra on the day it listed. And then as you watch the share price drop down from $9 or even $8 down to $7, you thought, okay, Telstra's dropped by $1, I'm going to buy another $1,000 worth. So you throw another $1,000 at Telstra. You then watch the price drop from 7 down to 6. So you think, hey, it's dropped another $1, I'm buying another $1,000 worth. And so it goes. Now, if you kept buying Telstra every time it dropped by $1, here's what would have happened. Like the lump sum investor, you'd have bought Telstra here at about $8 or $9. Let's call it 8. You would have had the opportunity to buy it again here at $7, again at $6, down here at $5, at $4, and down at $3. And let's say we spent $1,000 on each price drop. So we bought at 8, 7, 6, 5, 4, and $3, which means we've essentially had 6 opportunities to buy Telstra on the way down. And at $1,000 per time, that's $6,000. Here's how many shares we would have bought. Here at $8, our $1,000 would have given us 125 shares. Down at $7, our $1,000 would have given us 142 shares. 166 shares when the price fell down to $6. 200 shares when the price was at $5. $1,000 would have got us 250 shares at $4. And 333 shares at $3. So by the time Telstra had fallen down to $3, we've got 1,216 shares for a total of $6,000. Now, if we take our $6,000 and divide it by the 1,216 shares that we own, our break-even price, or our average price into Telstra, is less than $5. It's actually $4.93. So unlike our lump sum investing friend who bought Telstra at $8 and has never been able to recover their money, and in actual fact has sat on some very, very big losses, even today in 2022, they still haven't recovered. By using our dollar cost averaging strategy, we've been able to buy as the price is dropping to a point where our average entry price is less than $5. And that was around 2010 when Telstra had fallen down to about $3 per share. So once Telstra came back up to around $5, we could have taken our money, broken even, or maybe held on a little bit longer until we were actually in profit. In other words, when Telstra actually went back to $6, rather than our lump sum investor who's sitting on a big loss, we're actually getting out with a profit. So in this case, our dollar cost averaging strategy has helped us to recover in a horribly falling stock. So when it comes to dollar cost averaging versus lump sum investing, here's what some of the experts had to say on YouTube.
Studies have shown time and time again that the best strategy for investing your money is just to dump it all in the markets as soon as you have it, and then you just keep it there.
Should you go all in, or should you phase your money in over time? Well, let's not beat around the bush here. Statistically, you are likely to get a better return if you invest all of your money straight away. That's it. Simple fact.
When you take all the money you have and you just invest it all into one lump sum, you actually rob yourself of the opportunity to teach yourself to buy on the dips.
Now, Dave Ramsey says dollar cost averaging, mathematically, you are always going to end up in front.
The biggest advantage of dollar cost averaging is the emotional advantage. But mathematically, if you just put it all in, you're gonna end up making more money at the end of the day.
Now, I disagree with that. You're not always going to end up in front. You're only going to end up in front if you lump sum invest into stocks that are going up. Obviously, if a stock is falling, you're not mathematically going to end up better off by lump sum investing the whole lot at the top price and holding on to a falling stock. Mathematically, that just doesn't make sense. So while, yes, potentially, over the long run, mathematically it makes sense to buy and hold shares as the price is increasing, yeah, absolutely. But we don't know what the price of the stock is going to do tomorrow. So psychologically, it makes sense to dollar cost average in a lot of situations. And dollar cost averaging can also be a great way to fix a trade that's going bad or gone bad. Now, John Bogle, otherwise known as Jack Bogle, is the founder of the Vanguard Group. And as of 2021, Vanguard reportedly has more than $7.5 trillion in assets under management. So this guy knows what he's talking about. And here's what he had to say about dollar cost averaging versus lump sum investing.
You'll probably do better most of the time. Nothing is universal if you invest it all in the same day. Right. That's the plus, because the longer you hold a stock, the better it tends to do.
And while it might sound like he's all for lump sum investing, he also did say this about dollar cost averaging.
If stock prices go way down in your, let's say, 6th year of investing, well, all of a sudden you're getting more shares for each dollar you invest. So it's a way of eliminating to the maximum extent possible the vagaries of the stock market, which in the short term do things for no explainable reason, except the stupidity or hope and fear and greed of investors, all those emotions that get into the game. So dollar cost averaging, absolutely yes. Under those circumstances, it will apply to probably 95% of all investors.
Now, Vanguard actually put out a very comprehensive study about dollar cost averaging versus lump sum investing in 2012. And to summarize, they essentially said that lump sum investing actually outperforms dollar cost averaging most of the time, about 70% of the time. Now, the problem with this report is it's easy to look at the big numbers and say, yeah, dollar cost averaging versus lump sum investing. Lump sum investing outperforms, dollar cost averaging by, 70% of the time. The problem is it's easy to look at the big numbers. We've got to read the fine print. And the fine print in the report actually tells us that the margins by which lump sum investing improves our probability of success, then the numbers are actually very small. So when we first look at this report, it would be easy for us to look at the big numbers and say, yeah, lump sum investing 70% of the time outperforms dollar cost averaging. So I'm just going to throw all my money into the market. We've got to look at the fine print and ask ourselves, what is the risk to reward ratio? What is the variation or margin of difference? In other words, if 70% of the time we make 1% more money, is it worth taking the extra risk? If 70% of the time we double our money, well, yeah, it's a no-brainer. So we've got to look more closely at the facts, because all things being equal, 70% of the time does not necessarily mean you're going to be in front more often because the margins are completely skewed. But if 70% of the time you're buying stocks and halving your money over 5 to 10 years before, finally coming good, yes, 70% of the time you're going to break even or make more money, but do you want to hang on to those stocks for 10 years? What if the 30% of the time we made our money in 1 year instead of 5 or 10 or 20? What if the 30% of the time, instead of sitting on losses of 50, 60, 70%, our losses were marginalised and we're only sitting on a few $1,000s or a few $100s or a few percent losses compared to the massive losses we're taking from our lump sum investing? So emotionally and psychologically, dollar cost averaging might be better in more of the cases than the lump sum investing. So we've got to look at the numbers a little bit closer. Now, when it comes to investing in the stock market, one of the greatest investors of our time, of course, is Warren Buffett. Now, Warren's reportedly worth about $113 billion. So it's probably worth listening to what he has to say.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Now, I find that very interesting that Warren Buffett would say that, because after all, Warren is very well known for buying shares and never ever selling them. His whole philosophy is built around buying good quality companies that are under good management, they have good assets and great backing, buying them at a good price, hanging on to them forever and never selling them. So it's interesting that he says that, when buying mutual funds or index funds, he doesn't know enough to get it right. So he says, I'd rather put my money in progressively than in a large chunk of cash at one time. Dollar cost average. And if it's good enough for Warren, well, that's good enough for me. He points out that even he doesn't know enough to get it right all of the time. None of us can. I mean, if we had a crystal ball and we knew unequivocally what our share was going to do tomorrow, 6 months, 12 months from now, well, of course, if we knew the price was only going to go up, we'd dump all of our money into it and just hang on for the ride. Alternatively, if we knew the price was going to drop, we'd hang on. We wouldn't buy the stock until we could get it cheaper, and we'd buy when the price was a lot cheaper than it is today. It's because we don't know what the stock price is going to do that we have the dollar cost averaging approach to conservatively get into the stock over a period of time. Now, obviously, the longer you're going to hang on to the stock, the less impact dollar cost averaging is going to have. Because dollar cost averaging in and of itself is going to average itself out over a longer period of time. In other words, if you buy a stock for $4, $3, $2, $1, that might make a huge difference over 6 months or 12 months. But over a period of 10, 20, 30 years, it won't matter that much at all, because the average price you paid, $5, $4, $3, $2, $1, over an average of 10 years might mean that you were buying that stock for an average price of $3 a year or $2 a decade or whatever. So the longer you go, the longer the average averages out. So let's do some test data. What I'm going to do is I'm going to do a test, and we're going to look at the top 20 stocks in Australia, and we're going to backtest them over, say, the last 10 years to see what dollar cost averaging would have done versus lump sum investing. So all I'm going to do is take the top 20 stocks by market capitalization, and we're going to look at them over the last 10 years or so and see what the actual difference would have been. And this will be a fun and exciting study. So what I'm doing here is a quick scan using my program here, which is Bull Charts, and this allows me to do all sorts of scans. All I'm going to do here is ask Bull Charts to present me with the top 20 companies in Australia with the highest market capitalization, the biggest blue chip companies, in other words. And then I can set up different parameters within the scan. And in this case here, rather than having to scan the whole ASX market, I don't need to, because I know the top companies are going to be in the top ASX 50. So I'm just going to scan the top ASX 50 stocks. And then I just tick the box that says only show me market capitalization greater than 0, just to weed out stocks that may have ceased trading or are no longer in the ASX 50 list. Within about a minute, Bull Charts gives me the list of stocks, and I can sort them in ascending or descending order based on market capitalization. What I'm going to do then is I'm going to scan through each of these top 20 stocks, and I'm going to look at the monthly chart data just to give me a longer period of time. And here's my 20 results over here on the right hand side. Then what I do is I just go through each of these 20 stocks, and I'm going to look at the open price in January of 2012 and then the closing price in February of 2022. So it's given me 10 years of data for each of these 20 stocks. Now, a couple of these stocks I noticed weren't trading on the ASX back in 2012, so I then skipped down the list to the next one. So for example, Coles, I will substitute for James Hardie, and South 32, I'll substitute with NCM, Newcrest Mining. Then what I do is I set up a quick spreadsheet with those 20 stock symbols, and I put down the cost of what the stock would have cost in 2012 in January, and what the last price is of February 2022. And I do that for each of the 20 stocks. Then what I want to know is, had I invested, say, $10,000 in each one of these 20 stocks for a total of $200,000 at the start of January 2012, how many shares would have that given me for my $10,000? And then work out what are those shares, the amount of shares I was able to buy back in January of 2012 for $10,000. How many of those shares, given that amount of shares, what is today's current value in February of 2022? And from that, I can see that by lump sum investing my $200,000, $10,000 into each of those top 20 stocks, my $200,000 has now grown to almost $786,000, which is quite a substantial increase. I've then calculated what the gain or the loss is for each of those transactions that I did, or each bunch of shares that I bought, and then show it represented as a percentage gain or loss. And as you can see, out of the 20 stocks, only 3 of them I would have lost money on, 17 of them I would have done very well on. As far as a win-to-lose ratio, that's 85% winners. So that's so far supporting our theory, or the Vanguard theory, of 70% of the time we're going to win money. In this case here, if I'd have just picked the top 20 stocks in 2012 by market capitalisation here in Australia and dumped $10,000 in as a lump sum, I'd have won on 85% of those stocks. And I'd be up close to $600,000 in profit. Now, the next thing I want to know is, of those 20 stocks, what is the lowest price that they reached over the last 10-year period? Because I want to know what is the biggest loss that I had to sustain during that 10-year period of time. So I go through each of the 20 stocks and I work out not only the entry price, the cost price in January of 2012, but what is the lowest price that that stock fell to in that 10-year period. Some of the stocks fell quite substantially, some of them didn't fall at all. In fact, the buy price in 2012 was the lowest price, so hence, supporting the fact of lump sum investing, dump in all our money and we just buckle up and take the ride. So by looking at the lowest prices that were reached, I'm able to see the lowest value that each of my $10,000 investments had fallen down to. And as you can see, a couple of these had sustained some fairly large losses, 60%, 77% in one case. So yeah, hanging on for 10 years, we managed to sail through the storm, but emotionally and psychologically, man, we had to sustain some pretty big losses on a lot of these stocks during that time. So of course, to do a proper comparison, I wanted to know what is the difference with the lump sum investment versus the dollar cost averaging. So rather than doing all this data crunching manually, I went through all of these 20 stocks, looked at them as a monthly chart, and by right-clicking on the chart, I was able to save all the data within the chart as a CSV file, which gave me the ability to work with the numbers directly in a spreadsheet. And I did this with all of the 20 stocks. By doing this, I was then able to work out how many shares would have I bought over the 10-year period had I invested monthly $1,000 a month. So $1,000 per month times 10 months, $10,000. versus putting the whole $10,000 in one hit in January of 2012. So in other words, at the start of 2012, January, I either buy $10,000 worth of each one of these 20 stocks, or I buy $1,000 worth of each of the stocks and do the same in February, in March, in April, $1,000 each time. And in some cases, by doing so, like in the previous examples in this video, I ended up with more stocks because I was able to buy on the way down by dollar cost averaging. And in many cases, the lump sum investment strategy gave me more stocks, hence giving me a bigger profit at the end. So for each of the 20 stocks, I then calculated whether I would have ended up with more shares or less shares. And of course, like with the lump sum investing, I needed to calculate what is my current portfolio worth. So I still have $10,000 worth of shares, except it took me 10 years to buy them, as I invested $1,000 a month over the last 10. So rather than buying $10,000 worth of shares on January 2012, I've bought $1,000 worth of shares every year for the last 10 years. So, January 2012, I dumped $10,000 into one stock, or I dump $1,000 and do the same January 2013, January 2014. So it goes. So lump sum investing every year over the last 10 years. So of course, the next thing I want to know is how many shares have I been left with over the 10 years by dollar cost averaging into the shares? And what is my current portfolio? So the amount of shares I've got times the last current price here in 2022. Then I start a new spreadsheet to work out the difference. What is my lump sum investment portfolio worth per stock versus what is my dollar cost average portfolio worth for each of the 20 stocks? And then of course we can work out the difference and decipher which would have been a better investment strategy over the last 10 years. So we already know that by doing a lump sum investment into these 20 stocks, we would have ended up with $785,913. By dollar cost averaging, we would have only ended up with $450,163, which is a $375,000 difference. It's a massive difference, 42% difference in this case. But you've got to remember, this has been over a 10-year period, and all of the studies, Vanguard, Dave Ramsey, have all alluded to saying over the long term, dollar cost averaging is going to be outperformed greatly by lump sum investing. Put all your money in, and over time, the share, because shares want to, go up. We all expect the share market to rise over time. We expect the economy to be doing better. Inflation is going to be higher, so the cost of goods to produce goods is going to be more. So companies are selling products for more. Their profits are increasing, their costs are increasing, the value of their business is increasing. So in the long term, we expect companies to be worth more in 10 years' time than what they are today. So it makes sense that in the long term, lump sum investing probably does outperform dollar cost averaging. Unless you got unlucky and bought 10 dud stocks. Or there was a major catastrophe and everything, the whole market fell over a 10-year period. We can see some stocks didn't do so well. And in some cases, dollar cost averaging would have done better. The longer the period, the more dollar cost averaging is going to be flattened. Because as I was saying previously, dollar cost averaging on a shorter term scale is going to be very effective, but soon your dollar cost average is going to be averaged over months or years or decades. Rather than saying I bought this stock over the last year for $1, $2, $3, hence an average price of $2, you'll soon find yourself saying I bought this stock over the last 20 years at an average price of about $5 a year or $4 per decade. We started with the basic question, if you had a spare wad of cash laying around, what should you do with it? Should you invest it as one lump sum and just throw it all into one stock or a basket of stocks? Or should you drip feed it into the market, your basket of stocks or your single stock, over a period of months, weeks, years, whatever? So should you lump sum invest or should you dollar cost average? And then we did a very basic scenario where we just said, hey, let's just randomly pick the top 20 stocks in Australia based on market capitalisation. Let's pick a random date that just happens to be 10 years ago from today, and let's do a comparison, whether we put $10,000 into each stock, so a total of $200,000, sit on it and wait for 10 years to see the result, which by the way was quite healthy. And we ended up with over $500,000 profit. But in reality, we probably wouldn't have just picked 20 random stocks. We possibly would have timed our entry better. We possibly would have done more research and found better stocks than just 20 random ones. Maybe picking just 20 stocks wasn't enough. Maybe we needed to backtest 50 stocks or 100 stocks, 200 stocks. We could have potentially diversified our portfolio. If we're owning 20 stocks, we might have wanted to own a couple of technology stocks, a couple in the banking sector, maybe mining stocks, maybe the industrial sector, telecommunications, to again diversify our portfolio even more, to maybe lower our risk. At no point have we taken into consideration the additional brokerage. If you're buying stocks once, you're only paying brokerage once. If it's taken you 10 goes to get into that same stock, you're paying brokerage 10 times. And the difference could be huge. With an online broker like, say, CommSec here in Australia, you could be paying between $10 and $20 as an online broking customer per share trade transaction. So to buy $10,000 worth of stock online is about $20. If you have to do it over the phone because you're not an online customer, then it's going to cost you about $60. So if you do that every year or every month as your dollar cost averaging into your stocks, it's costing you $60 every time. So one stock, $10,000 one time, is $60 over the phone. That same one stock buying $1,000 over 10 years or 10 months or 10 weeks is $600. Times that by your 10 stocks, suddenly your brokerage costs are $6,000. So you've got to take that into consideration. The other thing you're missing by being a dollar cost averager is having your money in the market and owning the stocks over that whole 10 years, and you're collecting dividends on the stocks that you own. Obviously, as a dollar cost average investor, you're buying stocks gradually over weeks, months or years. You're going to get obviously less dividend payments because you own less of the shares at the time. If you've got a well-balanced portfolio and some of your shares may be paying, say, 5% per annum in dividend payments, well, over a course of 10 years, 10 stocks at $200,000, that could be an extra $100,000 just in dividend payments, because 5% of a $200,000 portfolio is $10,000 times 10 years is $100,000. So add that to your total profit, minus the extra brokerage that you're not having to pay by dollar cost averaging, which is potentially $6,000, and you could be miles in front. The other thing we did with the test was we said, if we're going to buy the shares over 10 years, let's also dollar cost average over 10 years. So we're only buying $1,000 worth of each stock. January at the start of the year, 2012, January 2013, 2014. So it goes. In reality, would we really do that? Or would we dollar cost average into the same stock that we bought in that year in the same year? In other words, if we're buying $10,000 worth of stock in January of 2012, if we dollar cost average into it, would we also want to be finished buying into the stock by the end of 2012? We probably wouldn't buy it every year over 10 years. We'd possibly do it over 10 months or 10 weeks. And that would skew our numbers completely differently. January, the start of the year, every year. What if instead of buying in January, we only bought if the stock price was lower than we'd previously bought it? So if we bought it in 2012 for $5 and the stock was $6 in 2013, we don't buy because we're paying more than what we originally paid. And we make a rule where we only pay less than what we've already paid. Like we did earlier in the Telstra example, and we're buying in the dips. Every time it fell by $1, we bought more and we ended up in front. Maybe that could have been a rule we could have implemented in this strategy. And that would have affected our results immensely. This test also doesn't take into consideration any of our own personal objectives. What are your objectives? Maybe you're a young person still in your 20s or even your 30s. And so you've got a lot of work in life ahead of you. So dropping $20, $30, $100,000 into the market and just sitting on it for 20 years, 30 years might not be a problem. An older person already in their 50s, 60s, 70s may need to pull income out of the market and can't afford to do the long-term buy and hold strategy. If they're just getting started in the market in their 60s and they're in their retirement years, lump sum investing for the long term is probably not the best strategy for them. What is your risk aversion? You know, if you drop 100 grand into the market and some of your stocks are dropped by 60, 70%, like some of the ones in the example, is that going to bother you? Do you think, that's okay, I can ride this out, I've got plenty of years left? Or if I take a hit financially, it doesn't matter, I've got a lot of work in life ahead of me and I can, recoup my losses from work or from some other investing opportunity. Those who have less tolerance for risk, maybe they're older or they just don't have the same tolerance for risk, they can't watch their portfolio drop by 10, 20, 30, 60, 70%. So dollar cost averaging over a shorter term might be a better scenario for them. So what's the verdict from this basic test scenario that we've just done? In my opinion, I can see that potentially dollar cost averaging is great in a short term. Over the long term, I agree with the experts. It works over a very long term. If you're buying a basket of stocks, or as Warren Buffett even said, an index fund, a mutual fund, you're investing in the ASX 200, the S&P 500, whatever fund you want to invest in, maybe a diversified portfolio. If you buy it and you forget it and you dumped all your money into it, then just collect the dividends. You're not paying much brokerage to get into the market and you just sit on it for years, decades, you're going to do well, more than likely. I think in the short term, and I'm talking 6 months to possibly 2 to 5 years, I can see potentially where dollar cost averaging could be hugely beneficial. So if you've found this video useful and this quick test useful, let me know in the comments below. If you'd like to see some more scenarios played out, perhaps some stocks where we test over a shorter time frame, maybe 1 year, 2 years, let me know and I'm happy to do a video on that. If you've enjoyed this video and found it useful, then please subscribe to my channel, hit the like button, hit the bell notification so you'll be notified of other videos as I produce them. I've certainly enjoyed putting this video together. It's been a fun experiment and I'm starting to produce a whole bunch more along this same theme. So if you found this useful, let me know in the comments below and I look forward to seeing you in the next one.